valuation approaches and valuation of intangibles, that is the topic that we have for our session today. I intend to make this session, friends, very interactive, and therefore I would like at any point in time and always all of you to be very actively participate in this whole program, because my experience of teaching and training for so many years tells me one thing, that the learning does not happen because someone is speaking. Learning does not happen because someone is listening. Learning happens because someone is listening and thinking about it. So, you all, as the participants of this program, how would I come to know that you are also thinking about whatever I am discussing with you? I would come to know of this only when you respond to the questions that I ask. At the outset, friends, let me tell you, being a valuation professional is not a matter of honor, privilege, or award. Rather, it is a matter of responsibility. As valuation professional, all of us have tremendous responsibility on our shoulder. And I'm sure you would have thought about it. Why is that the government of India thought of bringing out the valuation rules, which soon are going to be converted into a regular statute? Why is that so? Is it that the government of India was interested in providing additional revenue stream to chartered accountants, cost accountants, and company secretaries and the MBAs? The answer, of course, is no. The government of India is not interested in providing additional stream of revenue. But government of India definitely has placed tremendous amount of faith, confidence, and trust in the ability and the competence of all these professionals, and that is the reason why the government of India has brought out these rules of valuation rules. It's not that the valuations were not done in this country before the advent of the valuation rules. Valuations were done, but unfortunately, the valuations were done. There were a lot of wrong practices. And there were clear incidences of lack of corporate governance or lack of governance, and that is the government of India thought that giving this responsibility to these professionals, cost accountants, company secretaries, and chartered accountants and MBAs should help bring the valuation as a profession and also bring corporate governance in this country. So we have a responsibility, friends, and I would very strongly urge every one of you. Please remember, this program that we have, this profession which is now evolving in this country, has a phenomenal scope for every one of us. And but let at the same time also remember, this exam that you have to write to become a qualified valuation professional is extremely tough. I know many people who have appeared for this exam for 19 times and 20 times. Even after appearing for 19 and 20 times, they had not been able to crack this exam. That is the level of difficulty. And please understand, this level of difficulty indicates what? This level of difficulty indicates that the government of India wants only people who are absolutely thorough in their knowledge and understanding of the profession of the evaluation, and also the people who are committed and dedicated towards good professional standards and ethics. Only those people should come to the profession of the evaluation, and that is why this exam is really very, very tough. In my session with you today is going to be my endeavor that not only I should be able to help you to clarify conceptual understanding relating to the evaluation approaches, at the same time also help you to pass the exam, and at the same time also give you deep insights into the evaluation, so that as and when you become a qualified valuation professional, as and when you start practicing as a valuation professional, this knowledge and understanding that you gather in this session today should help you in becoming a good valuation professional as well. So that is the triple objective and motive that I had behind running this program, and I can tell you this will materialize with your very active participation. So let me ask you the first question, friends, and I would like all of you to answer. What is value? What do you understand by value? Everyone.
what we are getting or sale of some asset.
Okay, you can speak a little louder.
How much we get per product?
How much? Yeah,
Whatever.
one at a time. One at a time.
What is the amount of benefit that you are planning to get about the product?
Okay, very good. So, what is the amount that you are likely to get for a product? That is the value. Very good. What is fair value? What is fair value?
The value which is available in the market, or if you sell it in the market, we will get it up to that amount.
Up to that amount. So, that is the fair value. Okay, very good. What is
The
valuation?
valuation,
What is valuation?
The trick, the method of adapting, coming out with the value of the fair value of the particular asset is the valuation method.
Okay, very good.
method of calculating economical benefits of that product.
Method of calculating economic benefits of that asset or that liability is valuation. Okay, very good. Very good. Next question. What do we try to achieve while doing valuation? So, anyone who is doing valuation of an asset or of a liability, doesn't really matter as to what that asset is. That asset can be land or building, that asset can be plant and machinery, that asset can be financial assets, that asset can be tangible asset, that asset can be intangible asset, that asset can be even derivatives, that asset can be a financial instruments, that asset can be a government a bond, or it may be any other financial security. So my question to all of you is, when somebody is doing valuation, what is he trying to do?
To come out with the value of his assets, so that he can sell, he can come out with NCD or some other future, some other commitment he
Okay,
can have.
okay, very
To
nice.
initiate the discussion or to negotiate the price, we need to close the deal. We need to do negotiation. We need to have some start point.
Mhm.
Yes.
Okay, okay,
That is why the valuation has come into picture. And
okay, very good. Very good, friends. Now, let me add something to what you have said. Please understand what is value. What is value? And understand it very clearly, because once you understand what is value, I can tell you the remaining processes automatically become very clear to you. What is value? Value is, please remember, every asset has a utility. Every asset has a utility. What is value? Value is quantification of this utility of this asset is the value. Quantification of utility of an asset in terms of money is valuation. So what is value? Value, please pay attention, value is utility of an asset. Value is utility of an asset, isn't it? So an asset will have a value only when it has a utility. If that asset has got no utility, that asset has got no value, right? Isn't it? So please remember, a lot of these mining companies, after they have done the mining, they have to they after they have done the mining, they have all that land in their possession. But after doing all the mining, what they have to do, they have to reclaim that land. And as a result of that, after doing the mining, they are not going to get any money out of it. On the contrary, they have to spend money to put that land in a proper place. And therefore this asset, this mining area has got negative value. So what is value? Please remember very clearly, value is nothing but utility of an asset. Value is nothing but utility of an asset. What is valuation? What is valuation? Valuation is quantification. Quantification of the quantification of the utility in terms of money is valuation. Quantification of utility in terms of money is valuation. And please understand, why do we have to do this quantification of money, in quantification of utility in terms of money? Why do we have to do that? So what is the purpose of valuation? And please remember, that is the purpose of valuation. So the purpose of valuation is to take a decision. Is to take a decision. And how do we take a decision? can we take a decision about an asset, whether to purchase it or not to purchase it, whether to sell it or not to sell it, merely by looking at looking at an asset? And the answer, of course, is no. So if we have to sell, if you have to take a decision about an asset, whether to buy it or sell it or to hold it, we have to do the evaluation. So when we are doing the evaluation, what we are doing, please pay attention, what we are doing, we are simply trying to quantify utility of that asset in terms of money. So what is valuation? Valuation is nothing but quantification of the utility of an asset, and that is what is valuation. And I'm repeating it once again for the sake of clarity. And what is the purpose of valuation? The purpose of valuation is to take a decision. So why do we do everybody across the globe, whenever they are doing valuation of an asset or a liability, why are they doing valuation of that asset or that liability? Are they trying to complete some formality? And the answer, of course, is no. They are doing the valuation because somebody has to take a decision. So please remember, valuation is what? Valuation is not the methods and the approaches that we use. Valuation is not working on a piece of paper. Valuation is not a model that we create in the Excel sheet in the laptop. What is valuation? Valuation is quantification of the utility of an asset in terms of money. And why you want to quantify utility of an asset in terms of money, and that is because then only you can take a decision. So what is money? Money is a common reference point. Money is a common reference point for everyone, and that is what is valuation. Now, what is fair value? And please understand, it's very simple. The beauty about valuation is everything is so simple. The only thing is, when if we don't look at it in the right perspective, then things become challenging. So, what is fair value? Fair. What is fair? Fair value, fair. Fair means what? That means a value which is agreed by the buyer and the seller, who got a good knowledge and understanding of the product that they are buying or they are selling, and neither of them are under any kind of coercion or force or undue influence. Neither of them have any other consideration other than the price and the asset that they are going to exchange, and that is the fair value. So fair value is a value which is fair to both the buyer and the seller. And what is the meaning of the fair to buyer and the seller? The meaning of fair to the buyer and the seller is both of them have good understanding, both of them are aware, both of them are taking this decision knowingly, willingly, without having any kind of undue influence or coercion or any pressure, and that is the fair value. So these are the answers to 4 questions, and I'm repeating because please remember, it becomes the moment you understand what is value. Value is utility of an asset. Yes or no, everybody?
Yes.
Isn't it? What is value of an asset? A asset has got a value only if it has a utility. If an asset has got no utility, it has got no value. So that is value. What is fair value? Fair value is something which is fair to both the buyer and the seller. And what is valuation? Valuation is quantification of the utility of an asset. Quantification of a utility of an asset in terms of money value and money terms, and that is value. And what is the purpose of valuation? The purpose of valuation is to arrive at a decision. Somebody is interested in buying an asset, somebody is interested in selling the asset, and therefore obviously both of them need to take a decision. And how do they take a decision? They cannot take a decision merely by looking at the asset. They need to find out as to what is the utility that this asset has for me as a buyer. What is the utility this asset has for me as a buyer? This utility, unless and until I convert it in terms of a common terminology, I will not be able to take a decision. And what is that common terminology? That common terminology is the money. The reference point is money. So that is your purpose of valuation. What do we try to achieve while doing valuation? Please understand, it's very simple. When we are doing valuation, what we are trying to do? When we are doing valuation, we are trying to find out that reference point. Which reference point? That reference point that gives me an indication as to what is the utility value of this asset, and that is what we are trying to do when we are doing valuation. Now, which are the methods and approaches for valuation? We are going to discuss them together. And last question, friends, and I would like all of you to answer. As valuation professional, what should be our main driver? All of you. As valuation professional, what should be our main driver? Everyone.
To earn good money out of this.
Very
No,
good.
but no. Maintaining ethics.
Okay, okay. Is that your main driver while doing valuation to make more money?
No, it's a part because now the traditional sort of practice is going out.
Huh.
Now we have to be in the field of profession. Then we
Right.
need to have this type of thing. Otherwise, we will be out from the market.
Yes. So, see, no doubt, please remember, no doubt, as a valuation professional, you have to earn money, but money should not be the main driver. Money should be incidental. Main driver should be, main driver should be to help our client be able to take a decision which is based on a fair value, and that should be the main driver for all of us as the valuation professional. And please remember, as a valuation professional, our main job is to help our clients create value. When our clients create value, of course when they create value, and we become valuable. When we become valuable, we start getting good value also. So our main driver, friends, in the valuation process is to help the client to arrive at the fair value, and that is what it is. Now, with this understanding, friends, let us move forward and look at as to what are the approaches and the methods of valuation. I am sure all of you by now would have done some studies of the valuation, because you must always be preparing for your exams. So, would anybody would like to tell me as to what are the approaches that you have for the purpose of valuation? Or every one of you, what are the approaches for valuation?
Income approach
Mm-hmm.
and asset approach.
Asset approach, very good, very good.
Market approach.
And market approach, very good, excellent, excellent, excellent. So, will somebody like to tell me what are the methods of valuation under the income approach?
Basically, we will take out the projection of the company. That
DCF
basing on
method.
DCF method, okay, very good, DCF method, okay, and
Free flow of dividend method.
and
Dividend.
dividend method, okay. So dividend method, discounted cash flow method, okay. What else? What else?
discounting the for future earning of the company.
Okay, so that is discounting of the future earning of the company, means it discounted cash flow method. Okay, what are the methods under the market approach?
Asset. If you are into multiple projects, multiple verticals,
Mhm.
the name called having multiple verticals is yesterday was the question.
Okay. Mm-hmm. Okay, very good, very good, very good. What else? What else?
Is not able in
Discounting DCF at market.
But that is under the income approach. Now we are talking about the market approach. Okay, what are the methods available for valuation under the book value method, book value approach, book approach, or cost approach, or asset approach? Yes.
do after deducting depreciation.
Okay. Okay.
Net asset value.
Say it again, please.
Net asset value.
All right. Okay. Okay. Very good. Very good, friends. Very nice. So let us look at and understand as to what are the methods and the approaches for the purpose of valuation. Now, before we move forward, just remember and keep it in your mind. What is value? Value is utility of an asset. Value is utility of an asset. What is valuation? Valuation is the process of finding out, quantified in terms of money, the utility. So that is valuation. Value is utility of an asset, and I'm sure all of you must be totally clear. If an asset has got no utility, that asset has got a zero value. It is as simple as that. So the value of an asset is linked with the utility that asset has. So what is valuation? The valuation is quantification of utility of an asset. Please remember this. Why? Because if you understand what is value in the sense in which we have discussed, if you understand what is valuation in the sense in which we have discussed, let me tell you, you would be able to very quickly understand as to what are different approaches and what are different methods under those different approaches. You will very
Okay.
quickly understand.
Sir, can
And
you give, hello?
yeah,
Sir, can you give us some example?
not some, I am going to give you many examples.
No,
I'm
no, some example of the asset having no utilities.
Oh, many assets can be there, no, no, of zero utility.
Like you have said that mining, after mining, land becomes of no utility.
Correct, correct. And likewise in case of oil exploration, after you have done the exploration, the reserves are over, that asset has got no value. That asset has got a zero value. That asset has got a zero value. So any asset that you have, out of which you are not going to derive anything, that is a zero value asset. That because the asset does not have any utility. So for example, I would also tell you, for example, in your house, you may see that a lot of things which are lying in your house and you are not using them. And if you are not using them, that means what? That means those things have no utility. And remember, if those things have no utility, there is no point in carrying them in your house. Likewise, please remember, in a company, in the inventory, and I'm sure we all are practicing professionals, so we will understand it much better. हिंदुस्तान में बहुत सारी कंपनियां हैं जो अपने इस इन्वेंट्री में बहुत सारे मटेरियल को सालों साल कैरी करती हैं, and they are carrying it, and all that material had got zero value because it doesn't have any utility.
So they are carrying just for the sake of getting the working capital finance for the bank.
Correct. And that is, unfortunately, they are hitting themselves in that way also. So, because of the bad working capital management, they have to carry something which has got no value just to keep the bankers happy and satisfied. And what they are doing, they are doing bad working capital management and getting into trouble. Okay. So, that's number one. Number two, let's understand one by one as to what are the different approaches. So let us begin with the market approach. So first is the market approach, and please remember, we have discussed it. What is value? Value is, I'm purposely repeating it, friends, time and again, and that is because having passed this exam myself and having been in practice for last 3 years as far as the valuation is concerned, I can see from your perspective as to what kind of challenges you would be facing when you are preparing for this exam. And I know that what are the things, if you understand them quickly, your understanding of the entire valuation as a profession will become very, very clear. And that is the reason why I'm discussing it time and again.
This is
So
required also.
this is absolutely required because because now that I have the experience of passing this exam, I always think that I must pass that experience to all of you so that you are also very quickly able to pass this exam. Okay, so let's look at the market approach. Now we understand very clearly what is value is the utility of an asset. What are we doing in valuation? We are trying to quantify that utility in terms of money. And why are we quantifying that utility in terms of money? Because that quantification in terms of money will help us take a decision. Mm, uh, An asset having value is an objective information. Sorry, an asset having value is a subjective information. And with the subjective information, it is not possible to take a decision. So what we need to do, we need to convert that subjective information in terms of objective information. And that is quantification of utility of an asset in terms of money. Now, so what can be the approaches for the purpose of valuation? The one approach is market approach. Now, what it means? It simply means doing the valuation of an asset or a liability based on the market information, based on the market, based on what is happening in the market. What is happening in the market? Based on that, we try and do the valuation of an asset or a liability that we want to value. And since we are using market based information for the valuation of this asset, that is why it is referred as market approach. Now, under the market approach, there are certain methods for the purpose of valuation. So, what are those methods? Those methods, number one, fall into the category of initial investments, recent round of funding, and that would be applicable more in case of a startup. So if you are doing valuation of a startup, the valuation of a startup can be based on initial investment or more recent round of funding. So what you will do when you want to do the evaluation of a startup, you see as to what was the recent funding that was done. So what was the value at the time of the recent funding? So that becomes your starting point. And then what you do, you see as to what are the subsequent events that have taken place after the initial funding. Now you quantify all these subsequent events in terms of money as to what is the money value of these events to the company. Add that component to the initial valuation, and that becomes the value of the startup at the second stage. So that is your initial investment. Now under the initial investment there are two things. One is PORI. What is PORI? Price of a recent investment. That is PORI. Now please remember, in all likelihood you will definitely get a question as to what is PORI or what is port. PORI is price of recent investment and port is price of recent transaction. And I'm sure you can understand very clearly. Recent investment would mean as to at what price somebody has invested into a company. So that is PORI. And what is port? Port is price of a recent transaction. So in case if an asset has been sold in the recent past, at what price this asset has been sold, and that becomes the port. So price of a recent transaction or price of recent investment, that is port and PORI. And that is primarily for in case of startup ventures. Then under the market approach, what you also have, you have a comparable company or comparable transaction method. So what is, and no rocket science, please understand, it is very clear. Comparable company method or comparable transaction method. So I'm sure you can very easily understand when would be a comparable company method be applicable and when would a comparable transaction method would be applicable. It is very simple. When you are trying to do valuation of a company using, when you are trying to do valuation of a company by comparing this company with another company whose valuation you are aware of, that becomes your comparable company method. And then the second thing is comparable transaction. So in case of company, you are doing the valuation of the entire company. In case of a transaction, you are doing a valuation of a transaction. So somebody must have sold a house or a plot in the recent past in a certain area. So if you are planning to purchase a flat in that area of the same kind of configuration, or you're trying to purchase a plot in that area of same kind of configuration, how will you do the evaluation? You will do the evaluation based on the comparable transaction method. Comparable transaction method, that means you will try and see and find out as to has somebody sold this kind of a land in this area already in the recent past. Can I get some information about that transaction? So that base value becomes your basis, isn't it? It's so simple, and I'm sure it must have been experience of every one of us also. Whenever we must have bought a house for ourselves, wherever we may be, what we must have done, all of us must have done that before trying and decide and finalize the deal, we must have done some enquiries in that area. And that is what the enquiry that you did, what were you doing? You are trying to do the evaluation if following the comparable transaction method. So that's your comparable companies or comparable transaction method. Now in this case, what you do, in these cases you use the multiples. Now what is the meaning of multiples? I'm sure all of you would be aware. So EBITDA can be a multiple, sales can be a multiple, right? Gross profit can be a multiple, EBIT can be a multiple, earning per okay, EBIT can be a multiple. So EAT can be multiple. So, and how do you use the multiples for the purpose of valuation? Let me give you an example. So what you have, let's,
What is the word multiple mean?
okay, I'm coming to that. I'm coming to that. So multiple would mean, and please pay attention, there is a company X. The company X has been sold in the recent past at a price of 1000 crore. A company X had been sold in the recent past for a price of 1000 crore or was valued for 1000 crore. Now, this company X had the EBITDA of 100 crore. So company's valuation was 1000 crore, EBITDA was 100 crore. That means it has been sold at an EBITDA multiple of 10. Are you with me? The question that somebody asked me about the
Yes,
multiple.
yes.
Okay, so that is what is multiple. So this transaction which has taken place in the recent past has been done at an EBITDA multiple of 10. Now, how will this information be useful to me? Because I am doing a valuation of another company which is of similar type or similar kind as this company. So what will I do? I will check as to what is the EBITDA of this company. Let's say EBITDA of this company is 150. Now please remember, EBITDA multiple. What is the EBITDA multiple of the previous company? The EBITDA multiple of previous company is 10. 1000 crore is the value and 100 crore is the amount of EBITDA. So that means that company has been sold at an EBITDA multiple of 10. So that means EBITDA multiple of 10 becomes the reference point. Now, if I have to do transaction of another company whose EBITDA is 150 crore, so please tell me at what price this company should be valued, everyone.
1500.
15, 1500, absolutely 1500. So that is, friends, your EBITDA multiple. So as I gave you the example of EBITDA multiple, please remember it can also be applied. It can also be applied for the gross profit. It can also be applied for the EBIT. It can also be applied for the EBT. It can also be applied for the EBIT. So basically, this is how you will use the EBITDA multiple for the purpose of valuation. Then the third method that you have is industrial valuation benchmarks. Now, what is industrial valuation benchmark? Let me give you a straight away an example. So there is a hospital in that area, in the area in which you are staying. Now, this company, this hospital, the management of this hospital approaches you and they want you to do the evaluation of this hospital. So this hospital has got a 1000 beds, right? This hospital has got a 1000 beds. Now they come and approach you, please give us the valuation based on the industry valuation benchmark. So what will you do? You will try and find out, has any hospital in the same area or around that area been sold in the recent past, and you realize yes, there was a hospital that was a 500 bedded hospital and that was sold in the recent past, and that 500 bedded hospital was sold for 500 crore, right? 500 crore. So please remember, what is the valuation? 500 crore. How many rooms are there? 500. That means the value of that hotel which has been sold for 500 crore, the value of that hotel is 1 crore per room. 1 crore per room. Of course, friends, we are just discussing examples, so don't worry about the amounts, because 1 crore for a room in a hospital is much quite high, but we are trying to understand the process and the concepts. So now, if this hospital whose valuation you have been approached for, if that hospital has got 1000 rooms, what should be the value of this hotel, everyone?
1000 crore.
1000 crore, right? So this is your industry valuation benchmark. So same is the case for valuation of a,
Sir,
yeah.
only taking the bed is the only factor, or there must be some other multiple factor, because this particular hospital is giving facilities for different specialty type of diseases, whereas the other one is not giving that. There must be some other factors.
Very good, very good. I think
Then how you will come to a conclusion of having this evaluation?
excellent, excellent. Very good point. Very good point. Now, please remember, see, you are in the process of doing the valuation, and valuation is something that will not happen in a second. So, valuation is like building a house, constructing a building. So, you have to go step by step, step by step, step by step, step by step. So, the first, what you have done, first you have arrived the base figure of the valuation of this hospital, which is 1000 crore. Now what you will do? Now you will compare this hospital with the other hospital, and you will see what are the other facilities that were there in that hospital and which are there in this hospital. So what are the facilities which were there in that hospital which are not there in this hospital, and what are the facilities which are there in this hospital which were not there in the previous hospital? Now you will have to again apply your mind and expertise and knowledge and experience and try and factor those things also before you arrive at the final value of this hospital. So this is how you will do the valuation using the industry benchmark. So that becomes your starting point, and then of course you make all those adjustments. Now remember, the same way you can do the valuation of a hotel, the same way you can do the valuation of a cement manufacturing plant or a steel manufacturing plant, because what you do, you try and find out as to what is the value per ton of steel produced by that company, what is the value which is coming per ton of cement produced by that company. So you compare these numbers with any other another company whose values are available to you or known to you, and then you will use it. And finally, friends, under the market approach is the quoted price on stock exchanges. Now, please remember, you have Index 113, and at the outset, I will recommend to all of you to please make sure that you prepare yourself on the Index 113 very well. As the previous speaker was saying, and she was very right, all of you must read the International Valuation Standards (IVS). And for your information, there are two international or two valuation standards which are available prominently for every one of us. Number one are the valuation standards issued by the Institute of Chartered Accountants of India. So there is only one institute in this country that has issued the valuation standards in India. So all those who are chartered accountants, for them it is mandatory to follow the valuation standards issued by the Institute of Chartered Accountants of India. It's not that the others cannot follow. So even if somebody is member from ICSI or ICMAI or an MBA, they also can follow the valuation standards of Institute of Chartered Accountants of India. Then there is an Institute of then there is an Institute of International IBSC, International Valuation Standards Committee, IBSC. So you can also they also have issued they have been issuing the valuation standards. They have issued revised their valuation standards, and which are going to be mandatory from 1st January 2022. So from next year 1st January they are going to be mandatory. So you can also refer to the IVSC. Please go through them, because theoretically they will give you a very strong grounding in understanding the various concepts about the valuation. That is what number one that you do, so as to prepare yourself very strongly for this exam. And number two, what you should do is also go through the Index 113, which is on fair value measurement. Now Index 113 talks in terms of three level hierarchy of valuation. And what they talk about, level 1 is the quoted market price, and that is the method number 4 that you see on your screen. So that is quoted price in a stock exchange. That is level 1 input. Then level 2 input is the market information, that is the comparable company, comparable transaction is the level 2 input. And then there is level 3 input. So please pay attention. It means what? It means as a professional valuer, you must first use the level 1 input for valuation. And what is level 1 input for valuation? And that is in case if the business or the company that you're trying to do the valuation for, if that company is listed on a stock market or anywhere else, so whatever the quoted price of that entity, that becomes your prime base for the purpose of valuation. In case if the company is not listed on a stock market, then you go for the level 2 input. And what is level 2 input? That is the market information. So comparable company method is the level 2 input. Meaning what? Meaning you are doing the valuation of a company which is not listed on a stock market, but there is a company which is similar type, but that is listed on the stock market. So what you do, you try and use the information of this similar company which is listed on the stock market for the purpose of the valuation of this company which is not listed on the stock market, but which is of similar type as the other company which is listed on the stock market. So that is your label input 2, input level 2. Now if a company is not listed, that means input of level 1 is not available, or level 1 input is not available. The company is also not having any comparable company which is listed on a stock market. That means level 2 input is also not available. Then what do you do? Then you go for input level 3. And what is input level 3? Input level 3 is you create your own information to do the valuation, and therefore the discounted cash flow method that we use for the purpose of valuation, which is under the income approach, that becomes the label input level 3 as per the Indes 113, which is on fair value measurement. So now, having understood the market approach for the valuation, having understood different methods available under the market approach, let us now shift to the second approach for the purpose of valuation, and that is the income approach.
Sir, for DCF,
Yes.
suppose earnings are projected by the company.
Uh-huh.
Okay. Being a valuer, simply we will take the value of a projection of the company. The company always the projected higher side.
Mm-hmm.
Will it be okay for to work to remain in the conservative side, to safer side, to come out with the valuation of that enterprise?
What is your view?
No, basically either we have to seek the independent opinion of experts who are in the field,
Mm-hmm.
to have a projection certified by them.
Mm-hmm.
So by the side of company projection, we have to take that one also reference.
Mm-hmm.
Then we can come out to what was the past, what way the company was doing the past.
Mm-hmm.
Thereafter, in the what was characterized by the expert has given. Then we can come out with a third way of value PV, the
Okay.
third way of earning.
Okay. Now, very good. Please remember. See, that is the reason why I had discussed those questions in the very beginning. So let us come back. Where we started from. Number one, what is value? Value is utility of an asset. What is valuation? Valuation is to quantify that utility in terms of money. Then what? Why do we do the valuation? We do the valuation because somebody has to take a decision. And then we also need to understand what is fair value. Fair value is a value which is fair to both the parties. Now, from that perspective, if you are getting the projected financials for the purpose of discounted cash flow method from your client, and if you do not apply your mind to those numbers, and if you do the evaluation based on those numbers, now you tell me, will that really be correct valuation that we should have done? And the answer is no. The answer is no. So therefore, my responsibility is, and remember I said in the very beginning as to what has to be our driver as the valuation professional. Our driver as the valuation professional has to be to find out the fair value, isn't it? So if the company is giving you the projections, you and I as the valuation professional have a responsibility to study those projections, apply our mind, come to an understanding whether these projections and the assumptions which they have supplied to us, whether those projections are right or not right. So if and remember, it's not a rocket science that we cannot figure it out. It's just that we will have to do little more research. We will have to go deeper into it. So all the assumptions that they have given, all the numbers that they have given, we will need to study them ourselves and then come to a conclusion whether those projections are in line or they are not in line. If they're in line, then of course we can do the evaluation based on those projections. If they are not in line, then of course we'll have to tell the company that your projections are on the higher side, obviously, because they will never make the projections on the lower side. So we'll have to tell the company, if we have a doubt or we have a confusion, then what we can do then we can take help of an expert to confirm it to us whether those projections are right or not. And this is how you will have to take your stand actually. I hope that answers your query.
Yes, yes.
Okay, very good. So under the income approach, remember there are two methods. One is income capitalization and second is discounted cash flow method, right? I'm sure. So one is income capitalization. Let's understand the difference between the income capitalization and the discounted cash flow. And please remember, when we are doing the evaluation, we understand what is value. Value is utility of an asset. When we are trying to do the evaluation, what we are trying to find out? We are trying to find out the value of that asset. And what that value is quantified when it is the valuation is quantification of the utility in terms of money. So under the income approach, we have two methods, and please remember, why do we call it income approach? No rocket science. We call it income approach because under the income approach we are trying to do the valuation using income as the basis. Under the market approach we were using market information as the basis. Under the income approach we are doing the valuation based on the income. So under the income approach, two methods: income, capitalization. So that means what? That means this company must have been in existence for number of years. So what we will need to do, we will need to find out average income or last few years of this company. Average normal income. Please remember, normal income. Normal income, what is the meaning of normal income? All of us understand. That means all the, let's say we are taking last 5 years average. So in those last 5 years, all the non-recurring expenses or non-recurring income, we will throw them out. We will not take them into account. So we will take only normalized earning for those 5 years. Based on that, we will find out as to how much the average income coming to, and we will capitalize this average income by the cost of capital of that company. And this is how we will find out the value of this company. Okay, so that is your income capitalization method. Then you got a discounted cash flow method. Let us understand at this point in time, friends, what is the difference between the income capitalization and the discounted cash flow method. And the difference, of course, is very simple. In case of income capitalization method, you will use the income of the past. In case of discounted cash flow method, you will use the income of the future. And that is the only difference between the income capitalization and the discounted cash flow method. So we will discuss more and more in detail as to what is discounted cash flow method and what are the steps in case of discounted cash flow method as we move forward. But for the time being, I suppose all of you would be very clear that income capitalization, use the past income. Discounted cash flow method, you use the future income. And why discounted cash flow method is named as discounted cash flow method, and no rocket science once again, it is because when you are trying to find value of a company using discounted cash flow method, what you are doing, you are using the future earning. And when you are using the future earning, we all understand by common sense that the value of the money in future is going to be less than the value that I have today. So a 100 rupee note in my hand today is worth more than what it is worth 1 year from hence, or 2 year from hence, or 3 year from hence. So I have to take a decision today. So if I have to take a decision today, what I need to do? I need to convert all these future earnings in terms of present value. And for converting all these future earnings in terms of present value, I need to do the discounting of them. And since I discount the future cash flows, that is why it is known as discounted cash flow method, and no rocket science. And this is the simple reason as to why discounted cash flow method is known as discounted cash flow method. Now, please remember, in case of the discounted cash flow method, we use the free cash flow for valuation. And please understand this, and I'm sure by now, in any case, you would have got the answer. Why do we use free cash flow in case of discounted cash flow method? And we use the free cash flow for the purpose of valuation, because what we are trying to do, we are trying to find out utility of this company for us, and we understand what is utility, what is value. The value is when utility is quantified in terms of money. When utility is quantified in terms of money, that becomes the value. So a business has got land, building, property, plant and equipment, computer, furniture, and all those assets. Am I interested in buying those assets? Please remember, when I am buying a company, when anybody and everybody is buying a company, taking over a company, he is not interested in buying the land, building and property, plant and equipment. What is he interested in buying in that company? He is interested in buying in that company the cash generating capacity of that company. So therefore, if we have to do the valuation of an entity using discounted cash flow method, we will always use the free cash flow which is freely available to this company over the years. And that is what, friends, you must understand, and I thought I would touch upon on this at this point in time. So the third approach is the cost approach, and please remember, cost approach at times is also referred as asset approach. So you must be very clear about it that asset approach and cost approach are not two different approaches, because when you start preparing for this exam and when you're reading some books or some literature on valuation, you would come across somebody is writing this as an as cost approach, somebody is writing an asset approach, and you start wondering, are there two approaches, cost approach and the asset approach? And please remember, the answer is no. Asset approach and the cost approach are used interchangeably for the same. Now, asset approach and cost approach, why asset approach it is used? Because in case of the asset approach, what you do, you use assets as the basis for the purpose of valuation. In case of asset approach, all the methods that you have in case of asset approach, now all those methods use the value of the assets and the liabilities as the basis for the purpose of valuation, and that is why it is known as asset approach or cost approach. Cost approach because that asset has costed you something, and that is why they also call it at times as cost approach. So under the as cost approach or the asset approach, you got four methods. Number one is book value method. Very simple. What is the book value method? You have a balance sheet. Whatever in you have a balance sheet. In that balance sheet, you have assets and you have liabilities. So assets have the numbers and liabilities also have the number. So how do you find out the value using the book value method? Take the value of all the assets that you have minus the value of all the external liabilities that you have, and the remainder becomes the book value of that company. This is as simple as that, and that is your book value method. Then you got a adjusted book value method. Now what is the meaning of adjusted book value method, or how do you find out the value of a business using the adjusted book value method? Again, no rocket science. So in case of book value method, what you will do, you will take the values as they are given in the balance sheet. Under the adjusted book value, you will not take the values as they are given in the balance sheet, but you will try and find out as to what is the current value of these assets that you have. Say for example, you must have bought a land 20 years back when you started this company. At that point in time, you must have bought this land for 1 crore of rupees. Today, the market value of this land would be coming, let's say, 20 crore of rupees. Now, if you want to find out the adjusted book value, then you will not take value of this land as 1 crore. You will take the value of this land as 20 crore. That means you will make adjustment in the land value. Likewise, you have inventories lying in your godown, and the book value of that inventory is 20 crore, but you realize that if you go and sell of this inventory, the maximum that you receive is 5 crore. So what you will do, for the purpose of finding out the book value, adjusted book value, you will not take the value of the inventory as 20 crore, you will take the value of the inventory as 5 crore, and that is your adjusted book value method. And then you got a replacement method, which simply means in case if you were to replace these assets as they stand today, how much will that cost you? And that is your replacement method. And then you have a liquidation method. Liquidation method simply means if this company is going in for liquidation, if this company is going to be closed, then how much will you realize from the sale of the assets, minus how much you will have to pay for the liabilities that you have, minus how much money you would have spent in realizing and the disposal of the assets and the liabilities. So assets minus liabilities minus the expenses that you incur, what remains in your hand at the end, that is the liquidation value. So friends, these are the three approaches: income approach, market approach, and the cost approach. Under these three approaches, there are different methods as I have discussed with you. Now before I move forward, of course I will take your questions. Please go ahead.
Sir, this adjusted book value
Mhm.
of adjusted book value is same that of market approach. Is it of that type?
You tell me. You tell me.
Because we are adjusting each and every items of the balance sheet
Mhm.
with the market.
Hmm.
So market price means obviously you have to take the fair value.
Uh-huh.
So what is then can we put it at par with the same market valuation of industry valuation or comparable whatever the market approach?
Can you do that? Or will you do that?
We should not do, but
Okay. Oh no, good question. Good question. See, remember, market approach, you will, there are two premises for the purpose of valuation. The two premises are, number one, you have the premise of going concern, and the second premise is of liquidation. So invariably, you will use the book value approach for the purpose of valuation in case if company is on the verge of closure, generally speaking, and in case of a going concern, you will use the market approach. That is the difference, the principal difference. But at the same time, and you are right. Please remember, you are right. So, in case if you are doing the valuation of a company based on the book value, right? And if there is an asset that this company has, so if you want to find out the market value of this asset, of course you will have to use the comparable transaction method in that case. So if you this company has an asset, and to find out value of this asset, you will have to use the comparable transaction method. No issues about that. Perfectly fine. Because ultimately, please remember, please pay attention. Ultimately, what is your objective? Your objective is
to come out with fair view.
to come to the fair value. So, whichever method will give you the fair value, that is what you have to use. I hope that answers your query.
Yes.
Okay, good. All right, so with this, let us move forward. And what we will do now, we will spend, okay, but before that, few more things that I like to share with you. Now, please remember, as you can see on your screen, and let me just so income approach, please remember, is most fundamental, dependable, and reliable. Ignore at your own risk. So unless a company is going in for liquidation, if a company is going in for liquidation, then obviously you cannot use the income approach. You cannot use the income approach. You will also, you cannot use the income approach for the simple reason because company is on the verge of closure. So therefore using the income approach will not really work, because if the company is on the verge of closure, that means the company does not have the potential of generating income. So if the company does not have the potential of generating income, then obviously you cannot use the income approach. But please pay attention. In case of a company based on the going concern, you can use market approach. As a matter of fact, under Ind AS 113, you are supposed to use level 1 input, that is the quoted price, or the level 2 input, that is the that is your comparable, that is the information which is available in the public domain. So that is what you are supposed to do. But my recommendation would always be that if a business is a running business, if it is a going concern, that you must always use the income approach. And number two, the market approach, quoted price is fine, but I'm sure all of you will know many example of many companies who once upon a time were quoting at a very high market price, and today those companies are not worth even simple your writing paper. So that is what it is. So that is what you must remember. Quoted price you use, but always support them with the income approach, discounted cash flow, because ultimately you have to cement your valuation, and that is what you should do. And then finally, the the cost approach or the asset approach is good in case of when the company is going in for a liquidation. And this, of course, the book value, remember, book approach or the cost approach or the asset approach gives you the downside. It gives you the minimum value that you can accept, that you can expect to get from the sale of that asset or that liability. So friends, this is all about the approaches of valuation, and I thought I would spend little more time with you on how to do the valuation using the income approach, because in practice, please remember, globally it is the income approach which is used maximum. Market approach or the quoted price is used, but please remember, quoted price can be used only in case of an entity which is quoted on the stock exchanges. And most, it's not that all companies are quoted on the stock exchanges. So the valuations that are done are more of the companies which are not quoted, and therefore you will more often end up in using income approach, and under the income approach you will end up using the discounted cash flow method, and that is
Sir,
what we will discuss together
sir,
now.
deriving the cash flow,
Mm-hmm.
It is the same way which we derive in the balance sheet.
Yes, now that is what we are going to cover now actually. So that is what is our going to be next focus. In any case, I am covering this question that you have, so not to worry about that. Any other question, friends?